US stocks rallied to end a turbulent week as investors shifted focus to potential interest rate cuts by the Fed Reserve following a mixed jobs report, strong earnings from Nvidia and also Walmart. For more, let's head to London. We're joined by Kyle Rodder from Capital.com. Good to see you. Talk about what we've seen over the past week, and obviously Thanksgiving weekend throws a few issues at us, but what have we seen this week?
A bit of a recovery, actually, and quite a strong one so far. I mean, like you said, it's Thanksgiving now. Markets were closed overnight, and effectively they'll be as good as closed on Friday, more than likely, because trade will continue to be very thin. But the first 3 days of the week, more or less, saw a pretty significant rally in the S&P 500, and that's largely due to some dovish comments coming through some Fed officials on Friday of last week, as well as Monday of this week too. And we've seen this real whipsawing price action in the federal funds futures contract for December, which of course is the kind of meeting at the moment that everyone's speculating about whether the Fed will cut rates or not. It went down to about a 25% implied probability last week when we saw sort of the recent lows of the S&P 500. It's back up to about 85% now because some of this dovish rhetoric. So there is still a degree of caution and still a degree of high risk that some of that volatility may return. But for now, markets are betting once again on a rate cut in December, and that's pretty much what's driven Wall Street back from its lows.
Gosh, they've been waiting for data. The data comes, they don't like it.
Yeah, well, I mean, we've got some mixed data coming through effectively, some signs of maybe some resilience in the labour market, signs perhaps of some softer than expected retail sales, relatively speaking. There was also some producer price data that was kind of veering towards the more positive side of things, that, perhaps price pressures are sort of ameliorating a little bit. But I think what we're seeing at the moment, or at least what the markets are betting on right now, is that the Fed is kind of flying almost as blind as market participants are in respect that we've got some data, but it's not the good data that we want, the substantial data, which has been either delayed or completely cancelled because of the effects of the US government shutdown. And the markets are thinking, okay, well, what's the likely path of least regret for the Fed here when it comes to the December meeting? And the assessment is that, well, there's safer by cutting interest rates just in case and then reassessing the situation once the data comes through, rather than not, perhaps because of inflationary risks and running the possibility of being a little bit too restrictive on the economy there. So we're, again, flying through a little bit of a fog. The markets have digested a sort of a weak set of figures over the last few days and kind of said it's probably enough to see a rate cut in December. But again, the jury is still out, and we've got still 2 weeks between now and the next Fed decision.
Kyle, which companies this week played a crucial role in the performance, would you say? I mean, we've been watching Nvidia as Google's coming up as a threat.
Yeah, well, we have seen a broad-based rebound in tech stocks, and I think there's one thing to be said about this sell-off is that perhaps it's exposed just a little bit of extra value that wasn't there, a week or two ago, because the results that we did get from a lot of these tech companies for the earnings season that has pretty much just concluded were really strong. About 15% earnings growth across the S&P 500, the Magnificent Seven names, about 18% earnings growth for the quarter. But one interesting dynamic that we have seen this week is a little bit of a rotation within the sector itself and within the Mag 7 in particular. And a lot of that's come after, firstly, Alphabet released its Gemini 3 model, which is sort of being seen as raising the bar potentially for chatbots, AI chatbots. And the other really big development was the potential deal between Alphabet and Meta for the latter to buy the proprietary chips of the former, possibly threatening sort of the dominance and future market share of Nvidia, who clearly have the biggest and best chips in town at the moment. So we saw Alphabet hit a record high on the basis of that. Nvidia and AMD sold off, and so there's all this kind of rotation going on within the tech space too, as investors more or less try and judge who is going to be the kind of winner of the AI's race, at the AI arms race, who is going to sort of capture those sort of returns, relatively speaking. So again, it's been a tech-led rally throughout the week, and that's that interest rate story. But there's still investors here trying to sort of pick out who might be the AI winners, and there was a lot of that going on this week as well.
Obviously still concerns about what happens when we find out who the AI losers are as well. I mean, some interesting commentary we've seen this week about all of the companies that are borrowing so much money to be able to invest in data centers and to try and be one of the winners of the AI arms race, as you say. But if they can't pay back their debts. Sometimes we're seeing companies like OpenAI borrowing money from Nvidia essentially to pay them back for services. It's becoming a bit messy and a bit reminiscent of a credit crunch.
Yeah, I mean the Magnificent Seven's balance sheets are pretty solid. A lot of this has been funded so far through earnings and pretty much cash. There's been a little bit of sort of tapping the credit markets over the last month or so. Meta in particular was a noteworthy example to try and continue to sort of pump a lot of that capital into artificial intelligence infrastructure, again because there's this kind of slight bubble-like dynamic or behaviour where arguable race to the bottom emerges as companies try to capture again the kind of growth that's possibly on offer from this technology. But as you kind of alluded to, zooming out, the question becomes, all of this capital is pumped into this kind of physical infrastructure and resources to build out artificial intelligence. Will these hyperscalers in particular find ways to monetize this technology, or at least monetize this technology at a level that offers a reasonable yield for some of these investments that are being made in infrastructure? So, that's going to be one of those questions that'll be with us for a little while and probably won't be answered in the next few quarters. But still, an important one, and one that will have significant implications for economic growth, because a lot of this of the US's economic strength recently has been driven by investment in artificial intelligence, but also obviously investment returns as well, because so much good news and so much future growth is being discounted into stock prices at the moment.
All right, let's move on, because I want to talk about what's happening with inflation at the moment as well. Bureau of Stats monthly data for a quicker economic outlook is what we're looking at, but we're seeing it's risen to 3.8% inflation for October, significant increases in housing, food, electricity costs, all the things that a return to government was meant to be dealing with and fixing, but inflation's going up. Has this been a failure?
It's effectively a failure of, I would argue, successive governments for quite some time to not establish a much more productive and robust economy. And as a result, we're running into a situation now which is very similar to what is being experienced in the UK, although not as extreme, which is that we have a sluggish economy, a slightly stagnant economy when it comes to growth. Yes, consumers are, consumption's improving a little bit recently. Growth might pick up at the margins. But what we've effectively got here as a problem, and the RBA has articulated this in its last meeting, is that there is an imbalance between supply and demand. And even though demand is relatively tepid, historically speaking, growth is tracking below trend, supply is still quite rigid, and demand is still exceeding that supply, which is effectively what inflation is a manifestation of. So it's a bit of a problematic mix at the moment. I would also say, zooming out, that I believe going into next year, inflation is going to be something that rears its head once again right across the globe, mostly by virtue of the fact that we've got governments around the world still spending a little bit too much money at a time where inflation is a little too elevated, and that we still have central banks running either accommodative policy or looking to cut interest rates. So inflation hasn't gone away, certainly not in Australia, for a multitude of reasons, but this is also a global story as well, which unfortunately I think will be still a bit of a bugbear for households and investors going into 2026.
How significant is household inflation at the moment?
Well, house prices in particular are starting to pick up once again, and we're seeing that strength coming once more. Largely, it would be because of the pickup in demand because of interest rates cuts over the last sort of 6 months or so. But it's a perennial issue, and when we talk about the balance of supply and demand, I think most people would suggest that really it's another failure of policy, that we haven't got a housing market that can respond much more robustly to such strong demand with additional supply. The building pipeline is clearly not been strong enough, and clearly there's not enough housing to go around to satisfy the people that require it, and that's putting upward pressure on house prices. So remains a bit of an issue. Perhaps some of the steam will come out of the market now that consumers aren't expecting quite as much interest rate cuts in the months to come, perhaps again in this cycle, but certainly a policy issue that's problematic, and one that interest rate cuts over the last few months has not helped at all.
All right, Kyle Rodder, appreciate your time as always. Thank you.
Thank you.